Decentralized capital raising, building sustainable crypto projects with community commitment. One introduction. The rapidly evolving world of cryptocurrency presents a new frontier for raising capital and building digital ecosystems. The challenges faced by project founders are immense: securing resources, maintaining transparency, navigating regulatory hurdles, and perhaps most daunting of all, ensuring long-term sustainability. While traditional fundraising methods often rely on centralized mechanisms, the crypto space offers a radically different approach: decentralization. Decentralized capital raising offers a promising path forward, but it also introduces complexities that require careful planning. For projects to survive and thrive, they must move beyond short-term speculative interest and cultivate long-term value. In this context, community commitment, rather than mere financial investment, becomes the bedrock of a project's future. It is through this lens that we explore the principles and mechanisms that underpin the success of decentralized crypto projects. 2. The role of vision in project development. At the heart of every successful crypto project is a clear, compelling vision. Much like an architect presenting blueprints to a team of builders, the white paper serves as the initial sketch, outlining a roadmap for the future. It is not merely a document detailing financial returns or profit projections, but a blueprint for something more substantial: a decentralized ecosystem that promises utility, empowerment, and innovation. The white paper is not meant to promise returns or instant financial rewards. Instead, it should paint a vivid picture of what the project aims to build, whether that is a new financial infrastructure, a platform for decentralized applications, or a novel use case that solves an existing problem. The vision should inspire contributors to see beyond the immediate future, focusing on the long-term impact and potential of the project. Just as Satoshi Nakamoto envisioned a decentralized financial system free from the control of central banks, a successful project must present a vision that resonates with contributors on a fundamental level. It should be aspirational, practical, and above all, achievable. This vision is what attracts the early-stage community, those who are willing to contribute their time, resources, and expertise to make the blueprint a reality. Resource contribution models. Raising capital in the traditional sense, through venture capital, initial public offerings, or centralized fundraising platforms, relies heavily on monetary contributions. However, in the decentralized crypto ecosystem, capital is just one piece of the puzzle. To ensure long-term sustainability, projects require more than just money. They require infrastructure and human resources, the latter often taking the form of time value from contributors. A successful decentralized capital raising model taps into this broader spectrum of resources. Money, while essential, should be treated as a raw input into the project, much like crude oil awaiting refinement. It serves as the fuel that powers the project's early development, but it needs to be complemented by other forms of capital: CPU power, GPU power, infrastructure support, and community-driven research or testing. Incentivizing these various forms of contribution is key to the project's success. Rather than relying on speculative token models that promise instant returns, projects should implement a lockup period for financial contributions. This lockup mechanism ensures that the funds raised are committed to the project for a sufficient duration, enough to see it through its maturation process. Peer-to-peer token issuance is a natural fit for this model. By allowing contributors to retain control over their own assets and private keys, the project avoids the risk of central custodianship, which could be vulnerable to hacks or mismanagement. Through a transparent smart contract, tokens are issued directly to contributors who commit their resources, creating a decentralized, secure, and self-sustaining financial ecosystem. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Avoiding speculative behavior. One of the greatest risks in the crypto space is the tendency for projects to become entangled in speculative behavior. This is particularly evident in the world of meme coins, where tokens are often viewed as short-term investments rather than long-term value propositions. These projects frequently attract pump-and-dump speculators who artificially inflate the value of tokens, only to abandon the project once the price has peaked. To avoid this fate, Projects must distance themselves from speculative hype. The key to this is ensuring that the project's value is grounded in utility rather than financial speculation. A decentralized project that has a clear, sustainable vision will naturally attract contributors who are more interested in the long-term development of the ecosystem than in short-term profits. The focus should be on creating a platform that serves a genuine need, whether that is solving an existing problem or enabling new forms of decentralized interaction. Community participation is crucial here. As projects evolve, contributors should be involved in continuous feedback loops and iteration. These mechanisms ensure that the project remains relevant, flexible, and adaptable to changing market conditions or technological advancements. It is through this collaborative effort that projects can avoid becoming obsolete or irrelevant. 5. Incentives for community participation. A successful decentralized project thrives on community participation. This participation goes beyond mere financial investment. It extends to the time and expertise that contributors offer in the form of research, testing, and iteration. Rewarding these contributions is essential to keeping the community engaged and motivated. Staking mechanisms are one way to incentivize long-term involvement. By allowing contributors to stake their tokens, whether financial or in the form of time value, the project ensures that those who are most committed to its success have a stake in its future. These mechanisms not only encourage community participation, but they also help maintain the stability of the project by rewarding contributors with a portion of the project's success. Additionally, once the project matures, a fee generation mechanism, such as a subscription model or service charge, can provide ongoing revenue. This revenue is reinvested into the project to fund future development, ensuring that the project remains self-sustaining and can continue to evolve based on community input. 6. Regulatory considerations. Regulatory challenges are a constant concern for crypto projects, particularly those that aim to raise capital through token issuance. Many projects, such as initial coin offerings, ICOs, have faced scrutiny from regulators who view them as unregistered securities offerings. The Howey test, which determines whether an asset qualifies as a security, is a key factor in these discussions. To mitigate regulatory risks, projects must ensure that their token issuance mechanisms are designed in a way that complies with local regulations while maintaining decentralization. Peer-to-peer token issuance with a lockup period and clear mechanisms for value generation offers a solution that minimizes the need for central custodianship or management teams. By creating a self-sustaining, decentralized ecosystem, the project reduces its exposure to regulatory risk while ensuring that contributors remain in control of their assets. 7. The maturation process. The maturation of a crypto project is a complex and often unpredictable process. It requires a clear roadmap, a dedicated team, and a community that remains committed to the project's goals over an extended period. The project's success hinges on its ability to adapt, grow, and evolve in response to both internal and external factors. One of the key challenges in the maturation process is ensuring that the project does not become obsolete before it reaches full maturity. Technological advancements and infrastructure improvements can quickly outpace a project's development, making it irrelevant or less effective than newer solutions. To avoid this, the project must remain agile, open to feedback, and willing to iterate on its design as it matures. By focusing on long-term goals and aligning the incentives of all contributors, the project can navigate this maturation process with greater confidence. Once the project has reached its full potential, it should be able to operate independently, generating its own revenue and continuing to evolve through community participation. 8. Conclusion. The journey from initial concept to full project maturity is a long and complex one, requiring careful planning, resource allocation, and continuous community involvement. Decentralized capital raising offers a unique opportunity to build projects that are not only financially sustainable, but also grounded in utility, innovation, and long-term value. By aligning the interests of contributors, minimizing speculative behavior, and ensuring regulatory compliance, crypto projects can create lasting value for the global community. Ultimately, it is the vision that drives these projects forward, the desire to build something meaningful and impactful for the world. With the right resources, commitment, and community support, these projects can overcome the challenges they face and emerge as resilient, self-sustaining ecosystems that continue to evolve and benefit future generations.